Banks spend between $250 and $500 to acquire a single credit card customer. That's not marketing fluff. That's real acquisition cost. And they're perfectly happy to pay it. Why? Because the average credit card APR right now sits around 23%. And nearly half of cardholders carry a balance month to month. That means they're betting you'll swipe, revolve, and slowly bleed interest. They don't need you to be reckless. They just need you to be normal. The entire model depends on you being slightly disorganized, slightly impatient, slightly short this month. And here's the wild part. There's a way to flip that model completely. To cost them money instead of making them rich. Not by hacking anything. Not by breaking laws. Just by understanding the game better than they expect you to. Today, I'm going to show you the credit card cheat code banks absolutely hate. Hey, I'm Brian. I spend way too much time thinking about how financial systems are engineered and how regular people can quietly win inside them. And this isn't about getting a credit card. This isn't about rewards points. This is about exploiting customer acquisition economics. Because here's what's actually happening. Banks don't make real money from swipe fees. Those interchange fees are thin, competitive, boring. They make real money from interest. According to data from the Federal Reserve, U.S. credit card interest rates are hovering around record highs, over 20%. Meanwhile, research cited by McKinsey and Company shows that revolving balances drive the majority of credit card profitability. Translation? They'll happily give you $750, even $1,000 upfront, because they expect to make $3,000 back over time. And the math works in their favor. FICO says 30% of your credit score comes from utilization. Most people don't understand that. They max cards. They float balances. They pay minimums, which is exactly what the system predicts. Communities like Reddit, specifically the r/churning crowd, figured something out years ago. If you pay in full every month, if you never pay $1 of interest, if you treat sign-up bonuses like contracts instead of temptations, you flip the economics. Now the bank pays you $750 to $4,000 in value, and you pay them nothing. Think about that. They spend $400 to acquire you. They hand you a 4-figure bonus. And instead of becoming a 23% interest machine, you disappear to the next card. That's the part they didn't design for. Because the system wasn't built assuming discipline. It was built assuming behavior. And once you see that, you stop playing by the assumptions. You think this is theory? Let's talk about what happened in 2016. Chase launched the Chase Sapphire Reserve. The offer was insane. 100,000 ultimate rewards points after $4,000 in spend. At the time, that bonus was worth about $1,500 in travel. Sometimes more if you transferred to partners. The internet exploded. Blogs covered it nonstop. YouTube lit up. And over on Reddit, the churning community went into overdrive. People lined up, not to carry balances, not to pay interest, but to hit the bonus, redeem, and move on. Within months, hundreds of thousands of applicants flooded in. Many were bonus hunters, disciplined, organized, spreadsheet people. And here's the part most people don't know. JP Morgan Chase later disclosed that the card launch cost them far more than expected. Over the next several years, analysts estimated losses tied to the Sapphire Reserve program reached roughly $2 billion. $2 billion. Why? Because too many people didn't behave the way the model assumed. They took the bonus. They used the travel credits. They paid in full. And they didn't revolve. The bank expected long-term interest income. They got short-term bonus extraction. That moment forced banks to tighten rules, add restrictions, build defensive systems. But the core opportunity never disappeared. It just became more strategic. Because, even today, the math still works. Let's talk about what's available right now. Not theory, not nostalgia, actual money on the table. Rapid fire. The Chase Inc. Business Cash regularly offers bonuses worth around $750 after a reasonable spending requirement. The Chase Sapphire Preferred floats between 60,000 to 75,000 points, often valued around $750 to $900 depending on redemption. On the high end, The Chase Sapphire Reserve for Business has seen total value packages pushing $4,100 when you stack bonus points, credits, and partner transfers. And that's just one bank. American Express routinely offers 90,000 to 150,000 point bonuses on premium cards. Citi and Bank of America rotate elevated offers throughout the year. Conservatively, if you open 4 to 6 cards per year, spaced correctly, and hit minimum spend on purchases you were already going to make, you're looking at $3,000 to $5,000 per year in travel or cash value. More aggressive churners? $10,000 plus. Some documented cases go far beyond that. And before you say it, isn't this illegal? No, you're not lying. You're not faking income. You're not defaulting. You're completing the terms exactly as written. Banks design these offers knowing a percentage of people will game them. They just expect that percentage to be small. The entire system depends on most people being too disorganized to optimize. But if you're organized, if you track spending, if you automate payments, if you treat bonuses like contracts instead of temptations, you shift from customer to cost center. And that's where the leverage lives. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Now, before you get excited and start applying for 5 cards tonight, understand this. Banks aren't stupid. After the Chase Sapphire Reserve frenzy, they built defenses. Hard ones. Let's start with the big one. Chase 524 rule. If you've opened 5 or more personal credit cards in the last 24 months, Chase will automatically deny you for most of their cards. No negotiation. No reconsideration magic. It's algorithmic. Risk? You burn your chance at some of the most valuable bonuses in the game. Mitigation? Start with Chase cards first. Plan your sequence. Protect your 524 slots like gold. Next, Amex's once-per-lifetime rule. American Express generally allows you to earn a welcome bonus on a specific card once per lifetime. You grab a weak 60,000 point offer, and later a 150,000 point offer shows up? Too late. Risk? You waste your one shot. Mitigation? Wait for elevated offers. Track historical highs. Communities on Reddit and blogs document bonus histories obsessively. Then there's Citi's 865 rule. Citi limits how frequently you can apply. No more than 1 card every 8 days, and no more than 2 every 65 days. Risk? Instant denial. Mitigation? Space applications properly. Calendar everything. And Bank of America's 2/3/4 rule. Bank of America limits approvals based on how many cards you've opened in 2, 3, and 4-month windows. Risk? Shutdowns or denials. Mitigation? Slow down. Respect velocity. Now let's talk real consequences. Yes, banks can shut down accounts. Yes, they can claw back bonuses if they detect abuse. But here's the key distinction. Churning is legal. Abuse is reckless behavior. Closing cards immediately after bonus? Risky. So wait 12 months before canceling. Manufactured spending at extreme levels? Risky. So keep spending organic and reasonable. Missing a payment? Catastrophic. Mitigation? Autopay. Every card. Full statement balance. No exceptions. This isn't about beating banks with tricks. It's about playing precisely within the rules they published. Banks built guardrails. You just drive inside them. Now let's address the fear. Won't this destroy my credit? That's the myth. Here's what actually matters. According to the scoring model developed by FICO, 30% of your credit score comes from utilization, how much of your available credit you're using. When you open new cards, your total available credit increases. If you keep your spending the same, your utilization drops. Lower utilization equals higher score. Yes, you take a small hit from a hard inquiry, usually 3 to 5 points. Temporary. It fades within months. Meanwhile, your credit limit expands dramatically. Let's say you have $10,000 in total credit and carry $2,000 in monthly spending. That's 20% utilization. Open 2 new cards with $10,000 combined limits. Now you've got $20,000 total credit. That same $2,000 spend becomes 10% utilization. Your score often rises. Spend responsibly across multiple cards, pay in full, and over time your average account age grows too. The result? Many disciplined churners sit in the 780 to 820 score range. You can scroll through documented data points on Reddit. Thousands of users reporting improved scores while cycling bonuses. I'm not telling you to open cards recklessly. I'm telling you the fear narrative benefits the banks more than it protects you. The system assumes you'll confuse activity with irresponsibility. But activity plus discipline? That's leverage. And once you understand that, the game changes. So how do you actually do this without blowing yourself up? Simple. Sequence. Discipline. Tracking. Step 1. Start with Chase. Why? Because of 524. Once you go over 5 new accounts in 24 months, most Chase cards disappear for you. So you hit their ecosystem first. Think. Chase Sapphire Preferred. Chase Ink Business Cash. Potentially the Chase Sapphire Reserve. Space applications 2 to 3 months apart. Not because you have to, but because velocity looks risky to banks. Step 2. Autopay everything. Full statement balance. Not minimum. Not, I'll remember. Autopay removes emotion from the equation. Step 3. Track everything. Use tools like Award Wallet to monitor points, annual fees, and bonus deadlines. Set calendar reminders for minimum spend deadlines, annual fee posting dates, downgrade or cancellation windows. This is a spreadsheet game, not a vibes game. Now let's talk about spending. You do not spend extra to hit bonuses. You shift spending you were already going to make. Groceries, insurance, utilities, taxes, business expenses. If you don't naturally hit the minimum spend, you don't open the card yet. Advanced technique with a warning label. Business credit cards. Many people qualify using simple side income, freelancing, reselling, consulting. Business cards often don't report to personal credit bureaus, which helps preserve 524 space. But warning, never fabricate a business. Never inflate income. Banks verify more than people think. Again, we play inside the lines. Because this only works long-term if you're boring. Disciplined beats aggressive. Every time. If you're brand new, here's the simplest roadmap. Year 1. For cards. That's it. Month 1 to 2. Apply for Chase Sapphire Preferred. Hit the bonus organically. Earn roughly $750 to $900 in value. Month 4 to 5. Apply for Chase Ink Business Cash if you qualify. Another $750. Month 7 to 8. Add a mid-tier card from American Express when an elevated offer appears. Month 10 to 11. Round it out with a strategic offer from Citi or Bank of America. Conservative estimate? $3,000 to $5,000 in value in your first year. Without carrying a balance. Without paying interest. Without doing anything illegal. You just redirect spending you already planned. Then year 2. You evaluate annual fees. You downgrade instead of cancel when possible. You rinse and repeat. Slow. Intentional. Predictable. That's how you stay invisible. Let me reframe this. This isn't about gaming banks. It's about refusing to play the role they assumed you'd play. The system assumes you'll swipe impulsively, carry balances, pay 23% interest. Forget renewal dates. That's the 47%. Nearly half of cardholders revolve balances month to month. That's where the profits live. But the informed minority? They extract value. They automate payments. They track rules. They move strategically. I'm not telling you to exploit loopholes. I'm telling you to understand incentives. When you understand incentives, you see the leverage. And once you see it, you can't unsee it. So here's my question for you. If you treated credit cards like contracts instead of temptations, how much could you realistically earn this year? $3,000? $5,000? More? Drop your number in the comments. And if you want more breakdowns on hidden financial systems like this, the stuff banks don't advertise, hit subscribe. Because the difference between the 47% and the disciplined minority? It's not income. It's information. And now you have it.